Hey, everybody. Today I'd like to start or to talk a little bit about the basic accounting equations. I'm going to go ahead and share my screen and we're going to go ahead and jump right into it. So, so let's talk about the basics of bookkeeping. So, welcome to assets, liabilities, and equity. Everything we're talking about in a business boils down to these three categories. We're trying to keep score with the business. We're trying to measure certain things. So, what is an asset? Well, these are things that you own. Liabilities, those are the debts that you owe. And then equity is what's left over. So we call them the three O's for sure, the things that you own, the things that you owe, and what's left over. So let's talk about a real life, real world situation. So have you seen this happen in your life? So let's talk about purchasing a car. So let's say you go out there and buy a car for $10,000. So what is the car? Well, that's an asset. Why is it an asset? Because it's something you own. Then you don't have the full $10,000 cash, or you just want to take out a loan. So let's say the loan is 0% for now. We'll come back to that later. So you take out a loan for $8,000 on this car. What would that be called? Well, that's going to be called a liability. It's something that you owe. So the asset was something that you owned, the car. The liability is something that you owe. The loan for the car, in this case right here, is the liability. And you put down $2,000 as a down payment. You write a check, send an ACH, whatever the case may be. So what is that? So we have the asset, the thing that you own, the car. You owe the liability, which is the loan. And then what you put down is what's left over, or the equity in this case. So let's keep moving forward. Let's talk about the accounting equation. I think bookkeeping software is a wonderful thing. It's made our lives so much easier. But somewhere along the line, it kind of gave you a little bit of confusion because you don't see everything that's happening behind the scene. And that's why you need to start with these foundations right here. But understand that most of what we're talking about is handled behind the scenes. And when you get in the transactions, you're going to see exactly what I mean and how it helps you in this case. But every single business, whether it knows it or not, uses the accounting equation. It's the foundation. You can't produce financial statements, those key reports that we're going to talk about later, unless you're using the accounting equation. Assets equals liabilities plus equity. Let me repeat that again because you will hear that many, many times. Assets equals liabilities plus equity. Remember, we talked very basic, the building blocks. These are them right here: assets, liabilities, and equity. So let's keep moving forward into 7 basic accounting concepts. So there are many concepts professionals in accounting use to help them provide the best services to their clients, whether professionals or businesses. Some of the most common concepts include number one, revenue. For a business, revenue is the total amount of money that the company receives for selling its services and products. This means that a company's gross income before deducting any of its expenses is the revenue. You can do this by adding all of the company's earnings, equity increases, and interest it gains over the reporting period. A company may deduct its tax liabilities or various expenses from revenue to determine its profit. Now, let's distinguish. Revenue is not cash. Revenue is what the company earns. Okay, so we'll make that distinguishment later on when we talk about accounting cost cash method versus accrual method. The second major concept is expenses. Expenses are the costs a business incurs to generate its revenue. This includes your supplies, your materials, your rent, advertising, wages, contractor expenses, taxes, and so forth. So let's give an example. So let's say that you're a restaurant manager and you have to purchase your ingredients for your business. To earn income, the business it has to have expenses in order to generate its revenue. Third concept we want to talk about is assets. So here's the formal definition of an asset. It's defined by the Financial Accounting Standard Boards. And again, the Financial Accounting Standards Board is a board of people or a group of people that are set aside to make standard accounting rules and regulations that causes businesses to be able to be compared. So if one business is, let's say it's valuing its company one way using, some unknown method versus another company down the street, which basically runs the same way, but they're using a different accounting method, then you never would be able to compare those two businesses. You'd never be able to say, yeah, they're exactly the same, or one is really doing better than the other. So that's why we've got this Financial Accounting Standards Board that generates what's generally accepted accounting principles. And that makes it you able to compare companies within the United States. Other countries also use GAAP, generally accepted accounting principles. So that's why it's so important. We want to be able to compare companies, businesses, make sure that we're always comparing apples with apples. So getting back to the definition of assets. An asset is the probable economic benefits obtained or controlled by a particular entity as a result of past events. Yeah, basically, it's something you own. So that's just a long way to say it. But so assets can be broken down into current assets and non-current assets. So a current asset is basically a resource that the business will use within a year, such as cash, checks, receivables, inventories, prepaid expenses. So inventory is considered current because most of the time that you buy an inventory, you don't expect it to be sitting in the warehouse for a couple of years or any period of time. You're expecting that to turn. You're buying inventory to sell inventory, right? And that's how your business is growing, is by selling that inventory. A non-current asset or a fixed asset, on the other hand, is something that's long-term. It's something that the business will get a benefit for over more than a year. An example is like a stock or bond or land, buildings, equipment, even a computer. So a computer has a useful life of approximately, according to the IRS, the computer has a useful life of approximately 3 years. So obviously, it gets used over longer period than 1 year. Some people change out the computers every year. Some people change them out every 10 years. It really depends. But the way how the IRS defines it, it is considered something long term, and you should get a out of it over a year. Next key concept is a liability. So let's go back to the definition, the formal definition of a liability. It's called a probable future sacrifice. You have to pay back in the future a probable future sacrifice of economic benefits arising from a present obligation of a particular entity to transfer assets or provide services to other entities. Again, it's something that you owe to other organizations or other businesses or other lenders or creditors. So, like an asset, liabilities can be current or non-current. The difference, again, between these two is that a current is something that is due within 1 year. So these are payments. They include accounts payable, short-term loans, installments, tax obligations. Again, it's anything that you have to pay back within a year. This is opposed to a non-current liability. So a non-current liability, these are payments that are due with outside of a year. Excuse me. So it's things like a mortgage or long-term tax obligation. These are something that you would pay back over a year. So a mortgage you pay back over 15 years, 30 years. Let's say you take out a loan for the computer or for the car. A car is something that you pay back over 5 years, 7 years, 3 years, and those will be considered long-term, non-current liabilities. Move on to the next concept is capital. Capital can be anything that provides value or benefits for a business owner. It could be your assets, your machinery, your inventory, your patents. Although cash is a type of capital, capital is usually refers to investments that generate wealth in the business. So here are different types of capital. So you have working capital. Again, let's go back to the definition. It's an investment that you're making that's generating wealth. Working capital is usually calculated by subtracting all of your liabilities, subtracting all of your current liabilities from your current assets. So it's basically what is liquid, what the business has that's liquid cash to be used to generate your operations, to run your business, to generate wealth for the business. And it's usually something that's within 1 year. So it's a current item. Another type of capital is your equity. So we talked about equity early on being what's left over or the value that a shareholder will get. So let's say that the formal definition is the residual interest in the asset of an entity that remains after deducting its liability, excuse me. So it's basically the stakeholders, what's left. If I were to sell off my business, I would take all of my pay off all of my liabilities, sell off all of my assets, and whatever is left over is considered the equity. Let me give you a real life situation with equity. Your home. Let's say that you have a home for $1 million, but you have a loan on it for $750,000. If I were to sell that house off for $1 million, I would pay back the loan of $750,000. I would have $250,000 left over. That's what you would consider the equity in the house. Okay, moving on, another type of capital is your debt. So businesses can get debt capital through borrowing loans and bonds from banks and governments and private organizations. Okay, it's just basically, it's a sizable amount of money that you have that you're going to invest to generate some future wealth for your business. Next concept is financial statements, right? So this is where the money meets the road, right? This is where you do all of your reporting. It's the documents that basically summarize all of the transactions for the business or a person, right? Because you can have personal financial statements also. So here are some different types of financial statements and their definitions. First, we have the income statement. Sometimes it's also called the profit and loss statement. So this is the document that details the company's financial performance by reporting revenues, costs, and expenses during a period. It's important that we point out that this is during a period because income statements are just what the business is using and generating within a specific time period. They usually are reported monthly, quarterly, semi-annually, or annually. So that is as opposed to the balance sheet. The balance sheet is a financial document that reports the company's assets, liabilities, and equity. This is the ongoing value of the business. Okay? And we'll talk about how the income statement and balance sheet are related a little bit later on. Another key financial statement is the statement of cash flows. So a lot of businesses don't, people spend money and sometimes they don't really even realize where their money is going. The statement of cash flow is a statement that reports the amount of cash that a business earns and where it's spending it, right? So you'll see where money is coming in and you'll see where money is going out during a particular period. We'll look at these three financial statements a little later on. The final concept that I want to speak about is just accounts. An account basically is a type of transaction, such as a sale or cash. Businesses record accounts in a general ledger. General ledgers go into a trial balance. A trial balance goes into financial statements. So accounts receivable. So let's talk about like some specific accounts. Accounts receivable includes money a customer owes a company for goods or services. Accounts payable is the money businesses owes creditors or suppliers. Those are just specific types of accounts. And we can talk about chart of accounts in another time, and we can start looking at some more details later on. I just want to talk about the overview of these accounting concepts. This is a good time for me to point out. One thing a person loses sight of when you use accounting software is that whenever you do a transaction, there is always a balance. That means that there's always two sides of a transaction. There must always be one debit and one credit. Sometimes when we're talking about balancing the accounting equation, and we're talking about one debit and credit, we talk about T accounts. And it's simply if you were to draw a T on a piece of paper, there's a left side of the T and a right side of the T. Whatever balance is on the left side has to be the balance on the right side. That's why people draw out T accounts as a reminder that there has to be a debit and a credit. It could be multiple accounts, but there always has to be the debits. All of the total debits must equal all of the total credits. Just keep that in the back of your mind. So let's kind of look at some examples here. Here's two good examples. Let's say your company pays $5,000 in rent each month. Here's how you record it. So if you were just using QuickBooks or an accounting software, you would simply write a check in the QuickBooks. But the accounting behind it is that we would do a debit to an expense account, in this case, rent expense, and then we would do a credit in the payables account, meaning that we owe this. So again, see here on the left side, the debits, total debits equal total credits. Let's look at another example. Let's say that you just landed a new client for $5,000. They've agreed to pay you $500 deposit and the balance later on. So here's how you would record this. So we would record the sale, which is a credit to the income statement, and then we would record the receivables of $4,500 and the cash that we got as the deposit of $500. As we see, here's the T account. The left side, $5,000 equals the right side, $5,000. You've always got to make sure that your debits, total debits, equal total credits. Okay, so a debit is a record of all money expected to come into an account. A credit is a record of all the money expected to go out of account. Essentially, debits and credits track where the money in your business is coming from and where it's going. Hey, sorry about that. I had to go grab a drink of water real quick. Hey, let's continue on talking about debits and credits. So this chart is really a visual aid to help you understand debits and credits and basically where they fall on the chart of accounts and how they are affected. So let's talk about assets. Let's talk about our debits. So assets are on the balance sheet. And again, as we spoke about earlier on, assets are items that you own. A debit will increase an asset, while a credit decreases an asset. So this is a really important concept because not only do you need to know which balance sheet or which financial statement the account falls on, you need to know what the natural sign is and how an increase or a decrease will be recorded to that account. Let's talk about the converse, the liabilities. So a liability has a natural credit balance. So therefore, to decrease a liability, we would debit it, and to increase the liability, we would credit it. Moving on to revenues. So when we look at the income statement, we know that a revenue, for instance, a sale, has a natural credit balance. So to decrease a revenue, we would debit it, and to increase a revenue, we'd credit it. The opposite of the revenue on the income statement is the expense accounts. So the expense accounts have natural debit balances. Therefore, to increase an expense account, we would debit it, and to decrease an expense account, we credit it. Bouncing back to the balance sheet, equity accounts have a natural credit balance. If we go back to the accounting equation, we said assets equals liabilities plus equity. So if a liability has a credit balance, then an equity has a credit balance. So therefore, to decrease an equity, we would debit it, and to increase an equity, we credit it. This chart of accounts is really, this visual chart is really quite important for you to remember. A lot of people cut it out, just kind of paste it and just keep it in the back of your mind. What's the natural sign on the financial statements? Okay. So just real quickly, I just kind of want to talk about the financial statements. And let's start specifically with the income statement. So the parts of the income statement, a little bit, I'll kind of scroll through as we go through, as opposed to showing the whole thing. There are a couple different ways that you can show the income statement, right? Normally they start with, there's two different types. There is a multiple step or a single step income statement. With a multiple step income statement, we talk about the top section is the sales, then the next section is the cost of sales to give you gross profit. So although you don't see any signs on the income statement, keep in the back of your mind that sales are a credit balance and cost of sales are expenses, and those have debit balances. So that's why you would see the revenue minus cost of sales equals gross profit. And again, here, we're not seeing any signs, but we know that since the revenues are higher than your expenses, that this has a credit balance. Your gross profit has a credit balance. Okay? Moving down to the next section of your income statement is where we record all of your operating expenses. This is where you record your wages, advertising, repairs, and so forth. All of your expenses that you use in your regular day-to-day operations. Gross profit is a credit balance. Expenses are debit balances. So therefore, 55,000 minus your operating expenses of 30,000 will give you an operating profit of 24,000. As you see, again, there's no sign here, but we know that the sales were a credit balance, which is the highest. And so this actually is a credit balance. We're still in the positive. After you calculate your operating profits, then you look at other items, expenses, and other income. So then we've got other items like interest income and other income. Let's say that your business is a service business, but periodically you sell a book. That's not the normal, that's not your normal sales for the type of business that you run. So that would be considered other income. So now we've got the operating profit plus all of these other types of incomes that we have. We'd add those two together because that's a credit balance. Income or revenue is a credit balance. Now we're up to 27,000. Now we've got to take out more expenses. And everybody pays taxes, so we know that that's a debit. So 27 minus 4 is $23,250 net profit. Again, you don't see any sign here, but we know that net profit is a credit balance. If it were a loss, then you would see a negative because, again, whenever you see a natural sign, we would never see any other sign in front of it. We don't really want to see a loss. That is not the natural sign. So if this was actually a loss, then you would see the negative in front of it. A little confusing, but just keep in the back of your mind, we always want revenue to be a credit balance. Okay, now we're going to move down to the balance sheet. Okay, so there are a couple different ways that you would see balance sheets. So sometimes you see them next to each other. We see assets on one side and liabilities and equity on the other side. Sometimes you see them stacked on top of each other. So we see assets and then it would roll down to liabilities and equity. It doesn't really matter, just as long as you know at the end of the day that your total assets, 472,000, equals your total liabilities and stockholders' equity of 472,000. So let's look at some specific items that we've spoken about earlier on that shows up on the balance sheet. We have current assets. This is, like we talked about, our cash, receivables, inventory, prepaid expenses. And then we've got our long-term assets or non-current assets, where we talk about land, building, and appreciation. And then we come down to other assets where we talk about intangibles. So those are things like if you owned software or something like that, those would be considered intangible assets. Add up our total assets and we come to 472,000. Now we move over to the liability section. Current assets, accounts payable, notes payable. These are things that we're going to pay back within a year. Accounts payable are things like your bills, your light bills, your water bill, your rent expense. Again, these are things that you're going to incur on a regular basis and you're going to pay back within a year. Then we have long-term debt. Let's say that you bought a building or um, you bought a car or something like that. Like we talked about before, long-term debt is something that you're going to pay back over the long period. Then we come down to the equity section. Types of items that you would find in equity. There's common stock, additional paid-in capital, retained earnings, treasury stock. So common stock, I know that you guys are probably familiar with some of these items. So common stock is if you're trying to raise company money for your company, that's when you would issue a stock. So in this case, they were raising money to fund their business, so they issued stock of $10,000. Paid-in capital, when you start your business, you put money into your business to get it up and running off of the ground, or maybe people pay into your business to help fund the business. So this is where you record that. This is primarily cash, additional paid-in capital, any cash that you put into your business to fund or to generate more revenue. We'll come back to retained earnings in just a second. Treasury stock is when you purchase back the common stock that you previously issued. With small businesses, you don't find this very often, but that's just a general definition of treasury stock. Now, let's go back to retained earnings. So retained earnings is basically what is left in your business, right? This is all of the net profit that your business has generated over the years. Most people don't take, let's say that your income for the year is $100,000. Unless you take all of that money out, you roll it over into the next year because your business is a going concern. It is continuing to operate year after year. So the net profit from one year closes out into retained earnings, and then you start afresh with your net income for the next year. And then at the end of that year, you roll that into retained earnings. So to sum it up, retained earnings is basically how much your business it has earned year after year after year that you have not taken out the cash out of the business. And this is a good segue into making sure that you understand. Retained earnings is basically how you tie in your income statement and your balance sheet. Let's go back up a little bit. So in this case, for this year, our net income was $23,250. This is the revenue that was generated after all of the expenses. It's basically what was left over for the period. Let's assume that this is at the end of the fiscal year. We have $23,000 left over. If we don't take the money out of the business, this $23,000 will be closed out and rolled into this retained earnings line. In this case, retained earnings is $197,100. This business has been running for several years. So this 23 at the end of the year will increase this number over to 200 and $200,100. I have to do that math real quick in the head. Sorry about that. So that's how the income statement and the balance sheet are related to each other. So this kind of brings us to the close of our basics of accounting and bookkeeping. So next time we'll talk about some more details, detailed transactions, details in the accounts and so forth. But for right now, I think this is enough for you to chew on the basics of accounting and bookkeeping. So this is Sharon signing off for today. I hope this was helpful to you, and I'll talk to you next go around.